Today we're looking at a high-energy contrarian take on Plug, titled, Is the Bottom In? Why 1.80 Could Be the Ultimate Support. We're going to jump straight into strengthening that core thesis.
Okay, so let's start with that crucial narrative shift you have. The one from, bankruptcy fear to survival. It's compelling, but it needs a stronger fundamental anchor to really work.
Right, I see exactly what you're going for. You detail the funding, the $375 million note, the cash on hand, the improved burn rate. All the data is there.
The pieces are on the board, but the weakness is that you stop just short of the conclusion. You don't actually quantify the operational runway that cash provides.
Exactly. The reader is left to do the math themselves, and you can't afford that when you're trying to neutralize such a big fear.
So the suggestion is simple. Clearly define that runway. Tell us how many months of operation the new capital and the improved burn rate actually buy them.
And for a concrete example, you could just insert a quick, even a ballpark calculation. Something like, the combined funding secures, say, 18 months of liquidity.
Right. That instantly puts a floor under the entire argument before you even get to the upside.
Speaking of the upside, let's talk about maximizing your really original angles here.
Yeah, that mention of future revenue from AI data center backup power in 2026, it's a distinctive angle. It just needs to be pulled forward and integrated more forcefully into the immediate valuation thesis.
I agree, it's a fantastic element, but right now it kind of feels like a footnote. It feels disconnected from the actual trade you're proposing. Buy at 180, target 250.
So let's connect those dots. The suggestion here is to position that technical floor at $1.80, not just as a bounce opportunity, but explicitly as a discounted entry point for that unique 2026 AI story.
You could use more vivid language. Frame this as a pre-AI infrastructure play that's just trading at a crisis valuation.
And you mentioned the high short interest fueling a squeeze. That's good. But what if you connect that pressure directly to the delayed gratification of this AI catalyst?
Right. That gives the whole contrarian argument so much more depth. It's not just a technical reversal anymore.
Okay, finally, let's reinforce that big claim that $1.80 is the ultimate support. It's a powerful claim, but it would be much stronger if you fuse that technical fortress to a fundamental anchor.
Right now, the technicals, like the RSI being oversold, and the fundamental data on solvency are sort of presented one after the other.
You reinforce that ultimate support claim.
They need to collide. You need to synthesize the arguments to explain why breaking $1.80 is a fundamental problem, not just, the next line on a chart.
So how could you do that? Well, maybe explore if that $1.80 level correlates with an institutional cost basis or something similar.
Or, here's a concrete example. Link a breakdown below that price to the market suddenly pricing in the need for another highly dilutive capital raise.
Exactly. Then you've established a true fundamental failure point for the technical breakdown. That makes the $1.80 floor feel so much more robust.
So, to summarize the 3 actionable steps. First, calculate and state the operational runway to solidify that survival floor.
Second, maximize that 2026 AI catalyst. Frame the current price as a discounted entry into that future.
And third, anchor your $1.80 technical support by explicitly linking it to a real fundamental threshold.
Nail those 3 things, and this analysis goes from strong to undeniable.
We invite you to implement these suggestions and submit your revised material back to us for a